What I want to talk about today is stock replacement using a deep in the money long dated call instead of the spot. For the example, let's assume you're holding the SPY, and let's assume you're holding a lot. iShare SPY, SPY. You're a little concerned, Fed meeting, earnings, exogenous events in the world, but you still want to stay invested. What you could do is you can replace your stock position with a deep in the money call position. We call that another version of stock replacement. What I'm actually looking at is I want to have the same equivalent share position. Well, how do you figure that out? Well, that's quite easy. We can use delta as an equivalent share position. So let's assume I have 2,900 and some odd shares of SPY. To have the same upside exposure, all I would have to do is match the deltas to the amount of shares. So if I put on a stock replacement position that had the same deltas as the number of shares, i.e. equivalent share position, I would have exactly the same upside. The difference is I'm taking a considerable amount of money off the table. The rub on that is it's going to be a small cost to hold that deep in the money call. You'd pay about $85 or so a day to hold that deep in the money call for the benefit of taking risk off the table with the same upside. But $85 a day is a small price to pay, especially if you're coming into a particular period. Let's say it's the end of the year, you want to hold your profits, but you don't want to get out of the market. Stock replacement is a great, deep in the money, long dated call is a great alternative than holding the spot.